Section 2. Introduction to Anti-Money Laundering. Before starting anything, it is important to understand what money laundering and anti-money laundering are, and most importantly, why anti-money laundering is required. So let's begin. What is money laundering? Money laundering involves taking criminal proceeds and disguising their illegal sources in order to use the funds to perform legal or illegal activities. Simply put, money laundering is the process of making dirty money look clean. The United Nations 2000 Convention Against Transnational Organized Crime, also known as the Palmero Convention, defines money laundering as the conversion or transfer of property, knowing it is derived from a criminal offence, for the purpose of concealing or disguising its illicit origin, or of assisting any person who is involved in the commission of the crime to evade the legal consequences of his or her actions. The concealment or disguise of the true nature, source, location, disposition, movements, rights with respect to, or ownership of property, knowing that it is derived from a criminal offence. The acquisition, possession, or use of property, knowing at the time of its receipt that it was derived from a criminal offence or from participation in a crime. There are basically three stages of ML: placement, layering, and integration. Stage 1. Placement. Where cash obtained through criminal activity is first placed in the financial system. Examples of placement transactions include blending of funds, commingling of illegitimate funds with legitimate funds, such as placing the cash from illegal narcotic sales into a cash-intensive, locally owned restaurant. Foreign exchange. Purchasing of foreign exchange with illegal funds. Breaking up amounts. Placing cash in small amounts and depositing them into numerous bank accounts in an attempt to evade reporting requirements. Currency smuggling. Cross-border physical movement of cash or monetary instruments. Loans. Repayment of legitimate loans using laundered cash. Stage 2. Layering. Where the illegal cash is disguised by passing it through complex transactions, making it difficult to trace. Examples of layering transactions include electronically moving funds from one country to another and dividing them into advanced financial options and/or markets. Moving funds from one financial institution to another or within accounts at the same institution. Converting the cash placed into monetary instruments. Reselling high-value goods and prepaid access or stored value products. Investing in real estate and other legitimate businesses. Placing money in stocks, bonds, or life insurance products. Or using shell companies to obscure the ultimate beneficial owner and assets. Stage 3. Integration. Where the illegally obtained funds are moved back into the legitimate economy and are now clean. Examples of integration transactions include purchasing luxury assets like property, artwork, jewelry, or high-end automobiles. Getting into financial arrangements or other ventures where investments can be made in business enterprises. The figure shows a typical money laundering scheme. What is anti-money laundering? Anti-money laundering refers to a set of laws, regulations, and procedures intended to prevent criminals from disguising illegally obtained funds as legitimate income. Though anti-money laundering laws cover a relatively limited range of transactions and criminal behaviours, their implications are far-reaching. For example, AML regulations require that banks and other financial institutions that issue credit or allow customers to open deposit accounts follow rules to ensure they're not aiding in money laundering. Why is anti-money laundering important? Let's look at some statistics. The United Nations Office on Drugs and Crime, the UNODC, estimates that between 2 and 5% of global GDP is laundered each year. That's between 715 billion and 1.87 trillion euros each year. Every year, between $500 billion and $1 trillion of laundered money is generated through international banks and financial institutions. It is estimated that half of this laundered money is conducted through banks in the USA. There are many essentials to having an effective anti-money laundering system. Some of the core areas of importance are reduction of exposure of organized crime and corruption, boosting the legitimate private sector, strengthening financial institutions, economic growth and stability, increase of tax revenue, effective and efficient economic policy making, to reduce the risks to privatization efforts, to reduce the reputation risk for the country, to avoid the risk of international sanctions, to reduce the social costs, and to reduce operational, legal, and reputational risk.